Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Nick Cherney, Head of Exchange Traded Products at Janus Henderson, to discuss the new CLO ETF launched on Monday, October 19th. Nick, welcome to Trade Talks.
Thanks for having me, Jill.
All right, and tell me about the Janus Henderson AAA CLO ETF.
Yeah, this is a pretty exciting launch for us. As you guys know, right, there's a flurry of launches in the ETF space pretty much consistently every year for 10 years, and it's getting less and less common to have a launch that really provides access to a new asset class to investors. So we're pretty excited to bring JAAA to market, providing AAA CLO exposure. So really it's about high quality floating rate debt that typically has really only been available to a small pool of institutional investors, and making that broadly available for the first time.
Yeah, that is really interesting. Why is Janus Henderson seeking to democratize access to CLOs?
Well, I mean, really it boils down to, we think the market conditions are right. A lot of investors are concerned about the impact of long duration in their fixed income portfolios when we have interest rates as low as they are, and kind of seemingly only downside in terms of duration risk. And a lot of times they're having to seek fairly low credit quality investments in order to manage that duration exposure. And so we see, for example, a lot of investors in bank loans. The search for yield has led people into fairly low credit quality investments, and we see that AAA CLOs are providing very competitive yields and reducing that credit quality significantly. And so in a yield-starved environment where we are, also potentially running into some economic uncertainty that has a lot of investors nervous about the credit profile of their portfolios, we think the timing is really excellent to bring this product to market.
And Nick, what are some misconceptions that have followed the asset class?
Yeah, there's obviously quite a few. I think when people think of CLOs, either they're not familiar with them, or maybe they lump them in with sort of the kind of alphabet soup of sort of Wall Street acronyms. I think the important thing about CLOs is that they are distinct from a lot of the securitized investments that kind of gained notoriety during the financial crisis. In fact, CLOs have been around for more than 30 years, and during that time, no AAA CLO has ever defaulted. So I think probably the biggest misconception is just sort of confusing them with other similar acronyms around the securitized product space. I think that, the key thing for us is that kind of structuring, the sort of Wall Street wizardry that people tend to not like, sometimes it really does come with a significant benefit. And we've really seen that in the CLO market. That market has almost doubled in the last 5 years. And the reason is sort of, as I alluded to earlier, these really are a way to provide floating rate exposure in an extremely high credit quality package. And in that, the market conditions that we've seen, low rates, the kind of search for yield, to be able to have a product that is, AAA in rating and at an index level, certainly this AAA space is yielding, close to 180 basis points. That's a pretty compelling offering.
Yeah, it certainly is. And just to compare them to bank loans a little bit more, how do AAA CLOs compare to investment grade floating rate notes in the current interest rate environment? Should rates go up, and they at some point will, does that impact them at all?
Yeah, I think, I mentioned bank loans as one area where we really saw a need for investors to potentially scale back some of the credit risk that they have, right? Bank loans are yielding kind of 4.5%, but you're invested in junk rated bonds. The other place where people are looking for kind of floating rate exposure is in the corporate floating rate note market. And, that is another category where we just see pretty obvious benefits in the CLO space. So the floating rate note market generally is on a kind of corporate debt. Let's say it is kind of single A plus sort of credit, and you're yielding maybe 50 or 60 basis points. So considering AAA CLOs have a higher credit rating and close to triple the yield, we really just don't see a compelling argument for sticking with floating rate notes if you have an availability for the CLO exposure that is now possible.
And Nick, to wrap up here, how does a fund like JAAA fit into a diversified fixed income portfolio?
Yeah, it's interesting. I think that, the big thing here is that people who are sort of just putting together building blocks in terms of asset classes, are probably underexposed to CLOs. CLOs are not part of the major indices. And so just from a typical diversification standpoint, it's a pretty large segment of the market that most investors just don't have represented in their portfolio. But more importantly, I think investors who are thinking about their fixed income portfolio in terms of, yield, duration, credit risk, this is a really powerful tool to get a sort of more optimal balance between those three. Again, reducing duration, reducing credit, potentially increasing yield. And so I think whether it's from an asset allocation standpoint or really from a returns and risk-based perspective in terms of building a fixed income portfolio, AAA CLOs have a pretty unique spot to fill.
All right, Nick, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.